Good evening, Malaysia. I'm Maisha and welcome to OMG News. Right now, we're going to take a deep dive into the financial turmoil that gripped Iceland in 2008, a crisis that not only devastated the island nation but also sent shockwaves across the global financial system. We will examine the causes, the impact on Iceland's economy and its people, and the remarkable recovery that followed. Joining us live is our reporter Nur Adriana, who is going to tell us on what led to the 2008 financial crisis in Iceland.
Thank you, Maisha. Today, we're diving into Iceland's financial crisis that happened from 2008 to 2011. Several key factors came together to create this serious economic problem. First, Iceland bank grew very fast. The three biggest banks, Kaupthing, Landsbanki, and Glitni, become more than 10 times bigger than Ireland's world economy. They borrowed a lot of money from other countries, which made them very big but also very risky. Second, the Icelandic central bank didn't control the value of the krona, Iceland money. This caused price for things like houses and cars to go up very fast. It also made it hard for banks to stay in business because the value of their money changed too quickly. Lastly, a big crisis in America also affected Iceland. When Lehman Brothers, a big bank in the United States, failed, it caused problems all over the world. It made it very expensive for Icelandic banks to borrow money, and many of them couldn't pay back what they owned. Iceland had to take strong measures to recover, like taking over the banks and putting limits on how much money people could take out of the country. It was a tough time for Icelanders, but they worked hard to rebuild their economy. Reporting live, this is Adriana. Now back to you, Maisha.
It is remarkable knowing the causes of the 2008 Icelandic financial crisis. How about the effects that has been arise from this crisis? Let's get our reporter Najah Nabila to unfold these stories.
Good evening, this is Najah Nabila reporting live from OMG News. Today we delve into the dramatic events surrounding the 2008 Icelandic financial crisis, a catastrophic event that sent shockwaves through the global financial community. In 2008, Iceland faced a severe financial crisis with profound economic effects. The first one, the Icelandic krona plummeted in value. The crisis began with the rapid collapse of Iceland's banking sector, which had grown aggressively by borrowing heavily from international markets. When this bank failed, confidence in the Icelandic economy eroded swiftly. The value of the Icelandic krona dropped dramatically, losing more than half its value against major currencies like the euro. This devaluation had immediate and far-reaching consequences for the cost of import and the overall economic stability of the country. The second one is inflation soared. As the krona devalued, the cost of import goods and services skyrocketed. Iceland, being heavily reliant on import for many essential items, experienced a surge in price across the board. This rapid increase in the cost of living led to soaring inflation rates, with inflation peaking at around 18% in 2008. Everyday expenses for Icelandic citizens become significantly more expensive, contributing to widespread economic hardship. The third one is interest rate spike. In response to the plummeting krona and rising inflation, the Central Bank of Iceland raised interest rates sharply in an attempt to stabilize the currency and control inflation. At one point, the central bank's key interest rate was increased to a staggering 18%. This high interest rate aimed to curb inflation and restore some degree of financial stability, but they also had the effect of making borrowing extremely expensive. This further strained business and consumer, exacerbating the economic downturn. Reporting from Reykjavik, I'm Najah Nabila from OMG News Station. Let's get back to my show.
It really does affect the economies, but after going through all this mess, how does the government act in order to overcome this matter? Let's connect to our reporter Adila.
Thank you, Maisha. So, the worldwide recession set off Iceland's financial crisis, which became worse by unfavorable currency fluctuations and poor banking regulations. There are several ways government do to overcome these issues. First and foremost, obtaining a 2.1 billion IMF loan was essential to keeping Iceland's currency and banking system stable during the crisis. One of the biggest IMF initiatives in relation to the size of an economy was the 2008 two-year arrangement loan, which accounted for 18% of the Iceland GDP. Additionally, the IMF allowed Iceland to maintain its social safety system. On top of that, the three main falling bands were nationalized by the Icelandic government shortly thereafter in order to stabilize the banking industry and stop additional collapse. The purpose of this action was to guarantee the ongoing operations and recover public trust in the financial sector. Finally, the Special Investigation Commission (SIC) was created by the Icelandic Parliament in December 2008 with the goal of looking into the financial crisis and holding those involved accountable. Following the SIC's investigation, a number of bankers and executives were found responsible of fraud and manipulating the market. As a result, the crisis and its underlying factors were widely recognized. That's all from me. Back to you, Maisha, in the studio.
Thank you, Adila. Now, let's connect to Farisha to know what can be concluded from this 2008 Icelandic financial crisis.
Thank you, Maisha. In the 2008 Iceland financial crisis, a study from Brian and Sigurd Johnson argues that the crisis resulted from agentic behavior, a deliberate action by bankers and their owners that violated the system rules and regulation. When the crisis hits on the October 2008, the consequences of this agentic behavior become starkly apparent, and the collapse of these major banks within days sank shockwave through Iceland's financial system and had ripple effects globally. The Icelandic krona plummeted in value, inflation soared, and interest rates spiked, plunging the economy into severe recession. Many Icelanders face unemployment and financial hardship as a result. In response, Icelandic authorities exhibit agentic behavior by implementing decisive measures to stabilize the economy. They intervene to nationalize failing banks and impose capital controls to prevent a complete collapse of the krona. Additionally, Iceland sought assistance from international bodies like the International Monetary Fund (IMF) to shore up its finances and stabilize its currency. Overall, the 2008 Icelandic financial crisis served a stark example of the consequences of unchecked agentic behavior in finance. It underscores the importance of balanced economic growth, prudent financial practices, and robust regulatory oversight to ensure stability and resilience in the face of global financial interconnectedness. As the economy continues to navigate complex financial landscape, the lessons learned from Iceland's experience remain pertinent in shaping policies and regulation aimed at safeguarding against future crises. That is all from News Reporter Farisha. Now back to the studio.
Thank you, Farisha. That's all for evening editions of OMG News. We hope you found our coverage informative. Stay tuned for games coming up next. From all of us here at OMG News, thank you for watching and have a great day.